Okay, let's unpack this idea. A 5 sigma event. Statistically speaking, it's something incredibly rare, almost impossible, really.
Yeah, like a lightning strike hitting the same spot multiple times.
Exactly. And that's the kind of term people sometimes use to describe Warren Buffett's investing success over, decades. It's just
Right.
off the charts.
Right. It suggests it's more than just luck. Way more. And that's what we're really digging into today, trying to understand the philosophy behind it.
Yeah.
How did he actually achieve that?
What's interesting, though, is that it's not, random, is it? It seems to stem from a very consistent, thought-out approach.
Absolutely. And this deep dive, using the wisdom of Warren Buffett as our guide, is all about pulling out those core principles. What fueled this, statistically improbable track record? Think of them as maybe some rules of thumb for how you think about value.
Right. And you, listening in, you're here because you want to get to the heart of it efficiently, thoroughly, cut through the noise, find the signal. So our mission here, let's call it that, is to distill the really key insights from Buffett's whole journey, give you a kind of shortcut to understanding why he's been so successful for so long without getting bogged down.
And that source, The Wisdom of Warren Buffett, it's a great resource for this. It lays out his thinking, pretty clearly identifying good businesses, the whole psychology of investing. It's all in there.
It's a concentrated look at his principles.
Yeah, the ones he's really lived by.
Okay, so where do we start? You can't really talk about Buffett without talking about the people who influenced him early on, right? The foundation.
Absolutely not. You have to start there. And the first really crucial one is Benjamin Graham, often called the father of value investing.
The Intelligent Investor, that book.
That's the one. It introduced Buffett to that fundamental idea of the margin of safety. Basically, buying something for, significantly less than you think it's actually worth.
So it protects you if you're wrong about the value.
Exactly. It's a buffer. Not just getting a deal, but building in protection against mistakes or just bad luck.
Okay, that makes a lot of sense. Like buying wholesale, but with the rigorous analysis first. But Buffett didn't just stick with Graham's ideas rigidly, did he? He evolved.
No, definitely not. Graham's approach, sometimes people call it cigar butt investing.
Cigar butts.
Yeah, like finding a discarded cigar butt on the street with one puff left in it. You pick it up, get that last puff for free.
No.
It was about finding companies that were statistically super cheap, maybe even failing, but the assets were worth more than the stock price.
Okay. Looking for that last bit of value.
Right. But then Philip Fisher came along, and his ideas pushed Buffett to think more about the quality of the business itself, its potential for, long-term growth. Fisher was about finding really well-run companies with strong competitive advantages.
So shifting from just cheap to fundamentally good, even if it cost a bit more initially.
Precisely. And then the third key figure, arguably the most impactful partner, is Charlie Munger.
A Munger.
Yeah, Munger really solidified this shift. He strongly steered Buffett away from those cigar butts towards buying wonderful businesses, as they called them, but at reasonable prices. Munger really hammered home the importance of sustainable competitive advantages, the economic moat.
That moat analogy is really powerful, like a castle defense.
Exactly. It's about understanding what stopped competitors from easily eating into their profits. That's the key insight. Not just a good company, but one that's protected.
Can we see this evolution in action? Like, compare a cigar butt to a Munger-influenced buy.
Sure. Okay. Imagine maybe a small, struggling textile mill back in the day. Graham might have looked at it and said, well, the looms in the factory building, if liquidated, are worth more than the stock price. That's a cigar butt. Short-term value, maybe.
Okay.
Now, contrast that with Buffett's big investment in Coca-Cola in 1988. Coke wasn't statistically the cheapest stock out there. Not at all.
Right.
Exactly. Massive global brand, pricing power, consistent earnings history, a huge, deep moat. The long-term returns from Coke just blew away anything you could have gotten from that struggling textile mill. It's a completely different mindset.
Okay, yeah. That contrast really makes it clear. So, based on Graham, Fisher, Munger, Buffett built his own framework. The book talks about the 12 immutable tenets. Sounds pretty serious.
It is. And it's comprehensive. These tenets really capture how he thinks like a business owner, not just a stock trader. And they're helpfully grouped into 4 areas: business, management, financial, and market tenets.
All right, let's break those down. First, the business ones. What makes a business attractive to him?
Okay, 3 key things here. 1, it has to be simple and understandable. If he doesn't get how it makes money, he generally avoids it.
Makes sense. Stick to your knitting.
2, it needs a consistent operating history. You need a track record to analyze, right?
Mm.
And 3, echoing Munger, it needs favorable long-term prospects, that durable mode again. It needs to have staying power.
Understandable, proven, durable. Got it. What about management? Who does he want running the show?
He looks for rationality, management that uses capital wisely, reinvests profits effectively, doesn't just, build empires for ego.
Okay.
Candor is huge, too. Being honest with shareholders about performance, good or bad. And finally, resistance to the institutional imperative.
So what?
The institutional imperative.
Yeah.
It's the tendency for companies just to copy what competitors are doing, even if it makes no sense for them. Herd behavior, basically. Buffett wants independent thinkers running the company.
Rational, honest, independent. Okay. Then the financial tenets, the numbers part.
Exactly. He wants high return on equity, ROE, shows they use shareholder money well. High profit margins shows pricing power and cost control. Low debt, crucial for stability. And he focuses on owner earnings.
Owner earning.
Yeah, it's basically the cash flow that's truly available to the owners after the company has reinvested what it needs to maintain its business and competitiveness.
The real free cash. High ROE, good margins, low debt, lots of owner earnings, solid financials. And the last category, market tenets. How does he approach the actual buying?
2 main things. First, you have to be able to determine the intrinsic value of the business. What's it really worth? We'll circle back to that. Second, you need the discipline to buy with a margin of safety. Buy it for significantly less than that intrinsic value.
That margin of safety again, it keeps popping up.
It's absolutely central. It protects you from errors, from the unknown. It's the bedrock.
Can we tie a few of these tenets together with an example?
Sure, American Express is a great one. He invested heavily, twice, decades apart. The business itself, pretty simple payment processing, charge cards.
Understandable.
Consistent history, definitely. The brand, a huge moat. Management, generally rational and candid. Financially, historically strong ROE and margins. And crucially, both in the 60s, after the salad oil scandal.
Salad oil scandal.
Yeah, long story, but it hit their reputation hard. And again, in the 90s, market worries pushed the stock price way down, well below what Buffett figured its intrinsic value was. That created the margin of safety he needed.
Wow. Okay. So multiple tenets lining up perfectly during a crisis. You mentioned intrinsic value there. He doesn't just see stocks as ticker symbols, does he?
Not at all. For Buffett, buying a share is buying a piece of an actual business. You're becoming a part owner. That mindset is critical. He's not thinking about the stock price tomorrow, but the business's performance over years.
Right. And how does he estimate that long-term value, that intrinsic value?
Well, the main concept is discounted cash flow, or DCF. It sounds technical, maybe.
A little.
But the basic idea isn't too bad. You try to estimate all the cash the business is likely to generate for its owners over its entire future life. Then you figure out what that future stream of cash is worth in today's dollars. That's the discounting part.
So like $1 earned 10 years from now isn't worth as much as $1 today.
Exactly. So you discount those future earnings back. It gives you an estimate, and he stresses it's an estimate, of the business's true worth right now. He compares it to figuring out the value of an orchard based on the future harvests.
Okay, projecting future earnings and valuing them now. Got it. And the stock market's wild swings, how does he see those?
As opportunities, mostly, not risks in themselves. When the market freaks out and pushes prices down way below intrinsic value, that's a potential buying opportunity for someone who's done their homework.
Mr. Market, as Graham called it.
Precisely. Mr. Market is there to serve you, not guide you. If he offers a silly price, you can take advantage. If he's overly optimistic, maybe you consider selling, though Buffett prefers not to set great businesses.
So volatility is your friend if you know the value. You mentioned Coke. Any other examples where he saw value others missed?
Well, think about his IBM investment back in 2011. The market was kind of down on IBM, worried about their old hardware business.
Right, big servers and stuff.
Yeah. But Buffett looked deeper, saw the value in their software and services divisions, the steady cash flows they generated. He did his analysis, figured the market was undervaluing that long-term potential, and made a big bet.
Looking past the headlines to the underlying earnings power. Okay. Now, something else distinctive is his portfolio. It's not super diversified, is it? He makes big, concentrated bets.
That's right. Very different from the standard advice of spreading your money thin across lots of stocks. Buffett believes that if you really understand a few businesses deeply, owning large stakes in them is actually less risky than owning tiny bits of many companies you barely know.
Diversification is protection against ignorance, I think he said.
That's the famous quote. It really underscores his confidence in deep analysis. If you know what you're doing, you don't need to diversify as much.
And that concentration goes hand in hand with holding for the long term, doesn't it?
Absolutely. He's not trading, he's investing. The goal is to buy and hold great companies for years, decades even. Let compounding do its work. That's where the really big returns come from.
We're talking serious long-term holding. Years, decades. Example of that.
Apple is maybe the most prominent recent one. He started buying significantly in 2016. He'd historically avoided tech, but he came to see Apple's brand, its ecosystem, customer loyalty.
The stickiness.
Yeah, the incredible cash generation. It became a huge position in Berkshire's portfolio. Not a quick trade, but a massive, long-term commitment based on understanding the business's durable strengths.
That takes real conviction, but it's not just analysis, is it? The mental game seems huge for Buffett.
Oh, absolutely critical. He talks constantly about emotional discipline, rational thinking, that famous line, be fearful when others are greedy, and greedy when others are fearful.
Easier said than done, though. Going against the crowd is tough.
Incredibly tough. It takes real temperament. You have to ignore the noise, the daily market chatter, the fear, the euphoria, and just stick to your analysis of the business's value. Tune out the talking heads.
Keep calm and carry on analyzing. Where did he really show that discipline under pressure?
Well, the 2008 financial crisis is a classic. Think about his investment in Goldman Sachs. The whole financial world seemed to be collapsing. People were panicking, dumping bank stocks.
Total fear.
Exactly. And Buffett steps in, makes a massive $5 billion investment in Goldman. It wasn't just about getting good terms, though he did. It was a huge vote of confidence when they desperately needed it, acting greedy when others were terrified. And it paid off handsomely for Berkshire.
Wow. That takes guts, or maybe just extreme rationality. Which brings us back to patience, right? Patience to wait for those moments and patience to let the investments grow.
Precisely. Patience is everything. He'll happily sit on piles of cash for years, waiting for the right pitch, the right company at the right price. He doesn't feel pressure to constantly be doing something. And once he buys, he's patient enough to let compounding work over the long haul. Wealth building isn't a sprint.
And valuation helps decide when to swing the bat. You mentioned conservative assumptions.
Yes. When he's doing that DCF, estimating future earnings, he deliberately uses conservative numbers. He doesn't project wildly optimistic growth. It builds in another layer of safety. And he tends to stick to businesses that are fairly predictable, even if they're not flashy. Easier to estimate their future.
Stick to what you know. You'd be cautious with projections. Any examples showing that patience and valuation working together over time?
GI Co's may be the ultimate example. He first invested way back in the 1950s. He saw their low-cost advantage in car insurance early on. He patiently held it, added to it over decades, and eventually Berkshire bought the whole company in 1996. That deep understanding of its value and moat, combined with decades of patience, it became a cornerstone of Berkshire.
Decades.
Or think about Wells Fargo in 1989. Banking sector was in turmoil, lots of fear. He saw a strong bank trading cheap relative to its long-term value and stepped in. Patience and valuation again.
It really does seem to boil down to these core ideas applied relentlessly. And Berkshire Hathaway, the company itself, seems built around this philosophy.
It totally is. The structure supports the strategy. Like, they historically haven't paid dividends. Why? So Buffett can reinvest all those earnings himself in businesses he understands, rather than sending cash back to shareholders who might not know what to do with it.
Keeps the capital compounding internally.
Right. And there's less pressure from Wall Street about quarterly earnings. He can genuinely think in terms of decades, not just the next 3 months. The whole setup reinforces that long-term, value-driven approach.
So the company reflects the man's philosophy. It's not just luck.
No, definitely not luck. It's a consistent, repeatable process. Analyzing businesses deeply, understanding value, managing your own emotions. That's the core of it.
And buying something like Burlington Northern Santa Fe, the railroad, that seems like a huge bet on a very long-term fundamental business.
Exactly. That 2009 acquisition was a massive investment in American infrastructure. Railroads have incredible moats. You can't just build another one next door. It fits perfectly. Durable business, essential service, generating reliable cash flow for the very long term.
Okay, so if we had to boil it all down, synthesize this deep dive, what are the absolute must-remember takeaways from Buffett's wisdom?
I'd say, first, that foundation and value investing margin of safety is key. Second, think like a business owner, using those tenets: business management, financial, market. Third, have a truly long-term perspective. Fourth, Master your own psychology, be rational when others aren't. And fifth, always focus on figuring out intrinsic value and buying below it.
And for you listening, understanding these principles, it's not just about stocks, is it? It's a framework for thinking about value, about long-term decisions and finance generally.
Right, it's a shortcut to more deliberate, strategic thinking about building value over time.
Which leads to a final thought for you to chew on. Buffett really stresses understanding a business deeply. So think about this. What's one company or industry whose products or services you use all the time? Could you start applying Buffett's basic tenets, simple business, moat management, financials, just to evaluate its long-term potential?
Yeah, where could you apply that thinking in your own world?
Something to ponder. Thanks for joining us for this deep dive.